Welcome to the deep dive. We've got the Q2 and H1 FY26 results for SRF Ltd in front of us, press releases, financials, the earnings call, the whole package. Our mission today, to really unpack what's going on inside this major Indian conglomerate.
And it's a fascinating picture, isn't it? Because on the surface, you see this huge success, but it's happening against a backdrop of some pretty tough market conditions globally. We're talking about profit after tax, PAT, nearly doubling in Q2, up 93%.
That's the huge number, yeah. But SRF isn't just one thing, right? They're into chemicals, textiles, films, a real mix. So the question is, where did that massive profit actually come from? And, what are they betting on for the future?
Exactly. I think the core theme for you, listening, is really understanding how a diversified company handles this kind of global uncertainty, especially when, well, one part of the business, chemicals, is just soaring while other parts are facing real headwinds. We need to see where that nearly doubled profit originated.
Okay, let's get into it. Starting with the big picture, the consolidated results for Q2 FY26, we're comparing these to the same period last year, CPLY.
Right. Give us the headlines. What did the overall company look like?
So consolidated revenue, it was up, but modestly. 6% growth from about 3,424 crore to 3,640 crore. So steady there. But then you look at EBIT earnings before interest and tax, that jumped 56% from 417 crore up to 650 crore. And the bottom line, PA, profit after tax, that was the dramatic one, up 93% from 201 crore to 388 crore.
Wow. Okay, so when revenue grows just 6%, but your profit explodes by 93%, that tells you immediately this isn't about just selling more stuff. This is about margins. Huge margin expansion somewhere.
Exactly.
And it wasn't a one-off either. If you look at the first half, H1 FY26, revenue was up 8% and PAT was up 81%. So this trend of really strong profitability growth, it's been sustained.
And the chairman, Ashish Ram, he basically pointed us right at it. Said performance was strong, quote, led by our chemicals business, even with, as he put it, a very uncertain global environment. So let's follow that lead. Let's dive into chemicals.
Yeah, we have to, because the chemicals business for CB, that's clearly where the action is. In Q2, CB revenue jumped 23%, went from 1,358 crore to 1,667 crore. That's a big revenue increase on its own.
Okay, 23% revenue growth in chemicals. What about the profit side?
That's where it gets even more dramatic. Operating profit for chemicals surged 96%. 96. From 246 crore to 481 crore. Think about that. This one segment, chemicals, it drove. Let me see. Yeah, 74% of the entire company's EBIT for the quarter.
74%. Wow. So it's not just the biggest part. It's basically carrying the profit load for the whole company.
It absolutely is.
Yeah.
Which, is great when it's working, but it does raise that question you mentioned.
About risk.
Yeah.
Is that sustainable? Having so much depend on one area.
That's the big strategic question hanging over this, isn't it? For now, though, they're clearly riding this wave. And if you look inside the chemicals business, you see it's a combination of technical skill and maybe some helpful global trends.
Right. Let's break that down. There are two main parts to it. Fluorochemicals and specialty chemicals.
Okay. Fluorochemicals, FDC. They hit record sales volumes for refrigerants. And crucially, prices were strong, particularly for HFCs, the stuff used in air conditioners and fridges.
Yeah.
And the company specifically mentioned that firm global prices were partly thanks to China putting quotas on their own supply.
Okay. So China restricts HFC supply, global prices go up, and SRF, having the capacity already, steps in and captures those higher margins. Classic supply and demand, influenced by policy.
Textbook example. Then you have specialty chemicals, SC. Performance there was also strong, higher volumes, better product mix, selling more of the high-value stuff, and they tightened up operations. They're also refreshing the pipeline. In the first half, they launched, one new active ingredient, 3 new agro products, and 1 new pharma product, and they said those are getting good traction.
So building their own future there. But even with all this success in chemicals, were there any warnings, any clouds on the horizon?
Well, the earnings call did sound a slightly cautious note. They mentioned that some big agro companies are delaying orders, pushing them maybe to late in the second half of the year. That suggests maybe some softness downstream. And, competition from China and certain specialty areas is always there. It's intense. So while they're flying high now, maintaining that 74% contribution, that's the challenge if the end market slows down a bit.
Which leads perfectly into their strategy, doesn't it? Because SRF is clearly placing massive bets on keeping this chemical momentum going, like that big partnership with Chemours.
Yeah, that Chemours deal is significant. It's for manufacturing and supplying specific fluoropolymers and fluoroelastomers, high-end stuff. And what really stands out is that SRF is aiming at the difficult-to-make chemical intermediates here, not the easy commodity stuff.
And they back that up with money. The board actually increased the budget, the capex, for that Chambers project, bumped it up from around 595 crore to 745 crore. Why the big jump?
They said it was to expand the scope, to handle different grades of these complex materials. They called it an ROI-based contract, so the investment is tied directly to expected returns from the partnership. And the target completion for that is December 2026.
So another 150 crore committed because they saw a bigger technical opportunity. And it's not just upgrading existing plants, they're expanding physically too, right?
Correct. Big news there. They signed a deal to buy about 300 acres of land in Odisha, costing around 282 crore. And the plan is to build large-scale chemical facilities there for both specialty and fluorochemicals. It's a clear signal. Advanced chemicals are the future focus.
And all this expansion, it relies on their own R&D, their know-how. Worth mentioning the IP numbers briefly. 501 patents applied for, 153 granted globally as at the end of September.
Exactly. It shows they're not just building factories. They're building factories to make things they invented or improved, protected by patents.
That's key to those high margins.
Okay, right. So chemicals is the powerhouse. Let's pivot now. What about the other parts of SRF, the segments that are maybe finding things tougher? Starting with Performance Films and Foil, PFB, revenue here was basically flat, actually down slightly, minus 0.9%, from 1,421 crore to 1,408 crore. But, and this is the twist, operating profit jumped 44%, from 83 crore to 119 crore.
Yeah, that's the paradox, isn't it? Flat sales, but profits soaring. How does that happen? It's purely margins again. Two things driving it. First, selling more of those high-margin value-added products, VAPs. Second, getting better prices, better realizations for both BOPP films and especially aluminum foil.
Okay, what helped the aluminum foil part specifically? That's another interesting policy impact. The company credited the performance there partly to anti-dumping duties on Chinese imports into India. Basically, those duties make cheap imports less competitive, allowing SRF to get better prices in the domestic market, like a protective shield for their margins.
So it's fascinating. Fluorochemicals benefit from China restricting supply globally, and aluminum foil benefits from India restricting imports from China. Trade policy is really shaping their profitability in multiple ways.
It really is. But, PFB isn't out of the woods. There's still global oversupply in BOPET films, the plastic film stuff. Too much capacity chasing demand. And they also mentioned some short-term disruption from GST changes in India, needing resizing and reprinting activities. So yeah, they're managing well internally, but the overall market is still pretty challenging.
Okay, now for the segments really feeling the pinch. Technical Textiles, TTB. Revenue down 11% here, from 536 crore to 474 crore. And operating profit took a big hit, down 41%, from 71 crore to just 42 crore. Ouch.
Yeah, that's a tough one. And what's clear from the commentary is the intense pressure from imports. Aggressive pricing on nylon tire cord fabrics and belting fabrics, again, primarily from China. Plus, domestic demand for polyester industrial yarn was weak, which they blamed on a long monsoon season affecting usage. They did manage to hold on to their market leadership position domestically, which is commendable, but it looks like they had to sacrifice a lot of margin to do it.
Right. And finally, the smallest segment, other businesses coated and laminated fabrics. Revenue down 19%, operating profit down 56%.
Yeah, that one got hit by, quote, prevailing market conditions and general overcapacity. It really shows how tough it is in the more commoditized spaces. Although there was one tiny bright spot mentioned, their laminated fabrics unit actually hit its highest ever production level. So even in a down market, they found pockets of operational excellence.
Okay, shifting gears slightly to the corporate level. There was some important personnel news. Rahul Jain, the president and CFO, is stepping down, effective December 12th, 2025.
Yes, and that timing is...
Well, it's significant when you put it in the context of everything else we've discussed. Think about it. The company is committing to these huge, complex, multi-year investments. The Chambers project, that massive new site in Odisha, the total cash outlay for FY26 alone is estimated around 2,300 crore.
That's a lot of money going out the door. And
Oh,
changing your CFO right in the middle of such a heavy investment phase, that's always a critical moment.
It really is. Plus, they mention the weaker rupee hitting Q2 results because of currency fluctuations against the dollar and euro. And while their debt is manageable, debt to equity is 0.35, the new CFO steps in needing to execute these giant projects perfectly. manage global currency swings, and keep a tight grip on the finances. Continuity and discipline will be absolutely key during this phase.
On a related note, though, they did get some external validation for their operations, named Supply Chain Planning Champion and Supply Chain Champion Diversified Sector at an industry ranking. So, operationally, things seem robust. Yeah, the underlying machine seems well-oiled. So, to kind of wrap up the main takeaway for you listening, the overall financial results look fantastic right now, but it's very much a story of concentration. The chemicals business, especially fluorochemicals, has this incredible strategic advantage in pricing power. And it's basically masking the margin pressure and headwinds hitting textiles and, to some extent, films. The big push into specialty chemicals looks like the right bet for now.
Yeah, it definitely feels like a company actively reshaping itself, moving away from the tougher, lower margin areas and just doubling down really on the high-end R&D driven chemical space with these massive investments.
They're putting their money where the growth is, clearly. And that leads us to, I guess, the final thought for you to chew on. We talked about the huge Chemours project expansion, the big Odisha land purchase, both aiming for completion around December 2026. Now, consider the CFO leaves in December 2025, a full year before those critical projects are due to come online. How crucial is nailing the execution of those multi-year high-stakes projects? And what does that CFO transition mean for maintaining financial discipline and focus during what's going to be a really intense investment period? It's something to watch closely as SRF tries to manage this period of high growth, high investment, and frankly, high risk, all at the same time.